Natalie Kenway, Global Head of ESG Insight at ESG Clarity, and this is The Green Dream, the video series where we interview senior members of the responsible investment industry. Today, I'm speaking to Linda Eling Lee, Managing Director and Head of ESG Research at MSCI. Thank you very much for joining me today, Linda.
Hi, Natalie. It's great to be here.
Firstly, can you talk a bit about the role, your role at MSCI, what your responsibilities are, and perhaps what you've been working on recently?
Well, I'm the head of ESG research at MSCI. Over the past decade, MSCI has invested a lot into building our capabilities to provide the most comprehensive set of ESG and climate risk data and tools to the global investment community. In my role, I oversee all of our content and methodologies that underlie our ESG offering. That includes our ESG ratings that cover over 10,000 entities and over 35,000 funds, as well as climate risk analytics that investors are using to measure their exposure to climate risk and help align with their net zero carbon commitments.
Wow, it sounds like you're kept very busy. So we've picked up some areas of research that you've been looking into for our questions. Can you share some recent findings around the ESG momentum and projections for this year?
Sure. There has been a great deal of acceleration, as we all know, into ESG investments throughout 2020 and coming into 2021. Every year for the past 9 years, we've actually been writing a report that highlights the key ESG trends to watch for the year. And this year, we're watching 5 big trends. So maybe I'll spend a couple minutes to touch on each of the 5 trends. 3 of them are on the big systemic issues, climate change, the biodiversity crisis, and inequality. And 2 of them are more market trends around where we see ESG investments and ESG data headed in 2021. So, first and foremost, of course, on climate change, despite all the lockdowns, we are very much still on this trajectory for a world that is really too warm to sustain life as we know it. And so, investors now are realizing that, the easy part of talking about climate risk is over, and they can't just be directionally correct by excluding a few fossil fuel companies from their portfolios. If they truly want to commit to aligning their portfolio with the aspirations of the Paris Agreement, they are going to have to consider doing things differently, maybe even quite drastic things, because very few companies in a typical portfolio today have businesses that are aligned with how they would need to operate in a much lower carbon and even zero carbon world. A second trend we're watching is around biodiversity loss. We think that 2021 is the year when at least the leading investors around the world are going to start to take this issue more seriously and incorporate it into their investment considerations. I do think that the lockdowns of the pandemic and the fact that COVID and the future pandemics are more likely now because we have encroached so much into forested land, that's really brought the whole issue of deforestation and biodiversity loss to the fore. And we do see a couple of things happening in 2021 that's going to start to make this more of an investment issue for investors. And that starts with a global summit that's happening pretty soon that could end up looking like the Paris Climate Agreement, but for biodiversity. And then to kind of round out the thematic issues we're watching, we have inequality. We know that there's been a lot of social strife and instability, and that's really brought home to investors that the social fabric around us is quite fragile, and it can be very disruptive to sustaining our prosperity. And so now we've seen some companies and investors make a lot of commitments to do their part, for example, to diversify their workforce and so forth. But the issue is really quite fundamental. It really transcends a lot of the boundaries and control of any given company. And so what we're watching is investors and companies that are focusing on maybe some creative solutions to tackle this issue in 2021. If I can then kind of talk about the 2 market trends that we're watching, one is on our favorite topic, ESG data. We're certainly going to see a lot more requirements to disclose ESG data, but now it's not just for corporate issuers to disclose the data. The requirements are actually being placed on investors as well. And in fact, companies may be actually more prepared for these disclosure requirements because they're more used to it. You know, we see this because MSCI interacts with about 10,000 issuers. They verify their ESG data on a dedicated platform that we have for issuers. And we've seen this dramatic increase in their preparedness on fielding ESG data requirements. So investors, on the other hand, they are scrambling a bit here, you know, because what's very top of mind at the moment, for example, is that the EU Sustainable Finance Disclosure regulations will require investors to disclose on a variety of ESG metrics on their portfolio companies, and investors are not fully prepared for that. You know, so I think what's going to be quite interesting to watch, Natalie, is, you know, whether the tables are going to be turned where investors are now feeling more the pain of ESG data disclosure requirements themselves, rather than companies that have typically been on the receiving ends of these types of these disclosure demands. All right, so then finally a question, you know, going into 2021 that everyone is watching is whether ESG investments are going to continue to enjoy the kinds of inflows that we've seen in the past years. And we think, you know, the short answer is yes. You know, we think that the growth for ESG as a category is going to be really underpinned by a new level of maturity that we see among market participants. There's just better understanding now that's informed by evidence and by data that's going to help tamp down on a lot of the hype or a lot of the skepticism around ESG. And so an example of being more evidence-driven really is around this question that has cropped up about whether there is a price bubble forming and whether ESG investments are really kind of a self-fulfilling prophecy because there's just more assets flowing into the space. So, you know, we took a look at this, you know, and what we've seen is that over the past 7 years, you know, the top third of companies by MSCI ESG ratings have outperformed the bottom third by 2.56% per annum. And when we decompose the reasons for that outperformance, you know, what our analysis showed was that this outperformance was not actually explained by investors actually putting a higher and higher premium in valuing these companies with better ESG ratings. What our analysis showed instead is that this outperformance has been explained by the fact that these higher rated companies have actually just shown stronger earnings growth over this period. So they're just more competitive companies relative to their peers. So this is just one small example really of the kind of analytical evidence that I think is becoming more prevalent and available, and that's going to enable investors to make better investment decisions and really just build a more solid foundation for the growth in ESG investments in the market overall.
Fantastic. Well, you covered lots of interesting areas there, and we've definitely seeing lots in our Outlook series that 2021 is supposed to be a turning point in terms of ESG data. So yes, we're very excited to see how that unfolds as well. On the Paris Agreement, and obviously 5 years on from that now, investors that commit to aligning with the Paris Agreement, what challenges do they face and how can they overcome these?
Yeah, so let me first put some numbers around what like the scale of the challenge really is, right? So our team at MSCI, we took a look at the full public equities investment universe. That's almost 9,000 companies in the MSCI ACWI index. And when we looked at the emissions profiles of these 9,000 companies and we projected them out towards the next couple of decades, you know, what you see is that if nothing changes at all and everyone kind of operates business as usual, you know, these companies will be all on a path where the world temperature is rising by a little under 4 degrees by the end of the century. Of course, scientists tell us that would be disastrous. So if you as an investor, you've committed to aligning with the Paris Agreement, you only want to hold those companies in your portfolio whose businesses are producing emissions going forward in an amount that will be aligned with a lower warming pathway over the next decades, say the 2-degree warming, then the overall emissions limits for your portfolio is going to have to start coming down pretty steeply every single year. In fact, about 8% every single year from here on out. And that means the number of companies that actually can stay under that limit is going to shrink, you know, very rapidly. And by 2030, you know, by our calculation, only about 40% of these 9,000 companies that we started with today would actually meet the emissions profiles that's aligned to a 2-degree warming path. So that's like 60% of companies that kind of fall out of the investable universe, if you will. And so in terms of, investors trying to overcome this, we talk about a couple of different options for investors in our report. And two of them really are just not very attractive because it involves having to either divest from a large portion of the universe or finding ways to reinvest their assets into pools of available investments that are very small. But one option that we see as being preferred by a lot of investors is to actually get companies to change very drastically what their emissions profiles look like, going forward. As I said, on average, all companies would have to reduce their emissions by at least 8% every single year from now until 2050. That's pretty hard for companies. When we look back, only about 3% of companies have managed to even do that in the last, 5 years. So what investors, need to do is to dramatically change the behavior, in some cases, the business models of companies. They're going to have to step up the pressure by a couple of notches. We're beginning to see moves like proposals to change the board of directors at Exxon, or like the Say on Climate initiatives that is gaining traction. So, what investors have done in the past with private engagements and asking for more climate disclosures, those tools are just not going to be enough to get the kind of scale of the shift that they need to make this math work for Paris-aligned portfolios.
Okay, and you mentioned biodiversity loss and that there's going to be increased focus on that this year. What can investors do to tackle that in biodiversity loss?
Yeah, so this is quite a tough one because, essentially all industries are tied up in the functioning of our ecosystem. Now, where I think investors are going to want to focus is that there are some industries that are both have outsized impact on biodiversity as well as are heavily dependent on them. So, we can think about the food industry as being one of those major ones. Food producers obviously are dependent on healthy soil and crop diversity to grow abundant food supply for all of us. And at the same time, agriculture contributes to about 80% of the deforestation loss globally. That's because we have rising demand for cattle, for soy, for palm oil, and for timber. So for investors, it really makes sense to focus on these kinds of industries that are both high impact and high dependency. And what we see is that investors may be following kind of the blueprint that was established when they first started this journey to address climate risk. Virtually all investors today that are looking at climate in their portfolios, they started with understanding their climate risk by conducting a simple carbon footprint of their portfolio. And so where we think investors are headed, starting hopefully this year, is to conduct a biodiversity footprint. Now, this is not as straightforward to do because there isn't a single measure like carbon emissions that you can measure a portfolio by. But this is something that I think that the industry is going to try to figure out pretty soon. And what will enable that is that there are groups forming, including one that's modeled after the Task Force for Climate-Related Financial Disclosures. It's called the Task Force for Nature-Related Financial Disclosures. And they want to establish a disclosure framework that could help companies and investors actually improve disclosure on their biodiversity exposures. So it's going to be baby steps at the beginning, but I do think that investors are going to start making that move in 2021.
Okay, great. So we've talked quite a bit about the environment. So let's look at the social side. Can you talk about social inequalities, testing investors' creativity? You mentioned that in your research.
Yeah, social inequality. So investors have historically struggled with the social issues like inequality more so than the E and the G in ESG. And that's just because it's harder to measure. We've had a harder time actually linking it to company performance. But we now actually do have a better understanding, more analytical evidence about how precisely social issues can pose a financial risk to companies. So, in some recent research, we found that, when companies have governance problems, these problems actually tend to materialize in negative events, single events like ethics scandals that then precipitate a major stock price loss. And then in contrast, when you have poor environmental risk management, they don't tend to impact companies in these kind of dramatic episodes. What you see instead is a gradual erosion year after year of competitiveness that lead to lower stock price gradually over time. Now, social issues, super interesting, I think, because they can actually hit companies on both sides. Companies can get hit by these periodic negative events. If you think about lawsuits or strikes, but in the background, there's also this gradual erosion of waning productivity, stifle innovation that in our analysis have shown leads to lower profitability and stock price value. So we can now empirically show that the social stuff matters. And the pandemic has just made more obvious that companies and investors, that these are financially material issues. So then the question that we're struggling with, and I was referencing about, creativity, is what can you actually do about social issues that are so deep-seated? It's really beyond just companies making disclosures on the racial diversity of their workforce. You really need to do something new and different, and we're starting to see that. We're starting to see experiments like new vehicles like social bonds, which are like green bonds, but instead of the funds that are being raised being used for environmental projects, they're being used now to try to benefit society in ways such as expanding access to finance for the underbanked, or the funds are being used to provide drugs for underserved markets. So these financial vehicles, they're very new. And so of course they always will come with the problem of not having necessarily a clear standard for evaluating whether or not they deliver what they claim to deliver. But we are seeing companies and investors really wanting to try new approaches, creative approaches, because they know that a systemic issue like inequality, it's not going to be something that you can address with the try and true methods, that we know of. And so, only time will tell, but I do think that, anytime you try something new, you are going to have some failures, and you're not going to be able to deliver all the time on a promise that a new vehicle might be trying to deliver. But it's still really important to take that risk, because I don't think that something as systemic and entrenched and difficult to solve is going to happen unless we come up with and experiment with different creative solutions.
Yeah, I think, it's important to be realistic, but also make sure we are taking those steps in the right direction. Well, thank you very much for your time. I really enjoyed speaking to you today. It's been so interesting. The final question that we always end the Green Dream on is, what is your favourite sustainable drink or snack?
It's very hard to name one, because I do love to eat and drink, so just naming one seems seems quite difficult. So actually what I really love right now is a really innovative food delivery platform. It is a company called deliverzero.com. So I've been living in Manhattan throughout this entire pandemic. This lockdown, of course, has been really devastating to our neighborhood restaurants that we love so much here in New York. I know that a lot of us have turned to restaurant delivery, both because the food is yummy, and I'm not one of the people who's like baking up a storm during this pandemic, but also because we want to support our local restaurants, throughout this crisis. But the truth is that the amount of plastic containers and all the trash that you generate with every delivery, it's really been kind of weighing on my conscience, if you will. But recently, surprisingly, just by happenstance, I discovered a brand new business, Deliver Zero, and it works like it's a Grubhub, but it's using returnable containers, right? So my family's absolute favorite restaurant, it's an Italian place called Celeste here on the Upper West Side of Manhattan, is part of the Deliver Zero network. So the absolute best pizza and pasta in New York, it gets delivered to me in these Deliver Zero containers. I can set aside these containers after I finish, and then these containers are then retrieved by a delivery person the next time they deliver me food from a participating restaurant on the platform. And then of course it gets cleaned and reused by restaurants, and it just keeps going like that. So, how brilliant is that? I think that all restaurant delivery in the world actually need to change to this kind of a platform, because there's no reason to be so trash intensive just because we want to have some really yummy food. We can make things more sustainable. So I highly recommend it. You check it out if you're in New York. And if you're not, I think that they're fundraising. This is a startup. And so, I think that I love these game-changing ideas that can enable all of us to really live our lives much more sustainably.
That is such a fantastic idea. I really hope that comes to my area soon. Again, well, thank you very much for joining me, Linda. It's been great chatting to you.
Thank you. It's been great talking to you as well.